It's 5 o'clock. So welcome everybody to Break of Day Capital's 2024 Outlook. I'm joined by my colleague, Joseph Fang, who's going to be going over the macro environment and picture for 2024. At any time during this call, feel free to type in your question. At the end of the call, Joe and I will be answering. There'll be a Q&A session, but during any time you can type it in and we'll get to them at the end. So starting off with Break of Day Capital, just want to recap our CEO's Gary Lipsky, his biography. A lot of people, when it comes to bios, they just glance over them or skip to the next slide. And this is actually one of the most important slides in the deck that we have. When you invest in multifamily, you're investing with the operator and his team first, the deal second. Gary has an impeccable track record. He's been doing this for decades. He's written a book, and he's got a great track record, which we'll get into later in this call as well. This is our Break of Day Capital's team. Joe Fang and myself are on this call, and these are the other members of our team. So what to expect in 2024? I'm going to hand over the reins right now to my colleague Joe Fang, who's going to go over the macro environment.
Thank you for that intro, Adam. Yeah, so this is one of the biggest deals that we're having. One of the biggest issues that we've been having to deal with. This is the rapid interest rate rise last year. Was a bit of a sore point for many real estate investors, and so this is something that we pay very close attention to, and always looking for clues as to where they're going. And so for 2024. No, we're not economists. We don't play one on TV either. But what we do, we're not trying to forecast the Fed funds rate. We simply pay a lot of attention to a variety of macro analysts, and the estimates are anywhere from 3 cuts to 7, and could start as early as March. And today, with the retail numbers coming in stronger than expected. It seems like the probability is shifting more towards June now. So all this stuff is going to keep moving around, but I think that, as a, whether you're a homeowner or as a real estate investor, I think I would suggest that you concentrate on looking at the 10-year U.S. Treasury yield. And in a normalized market, which I think we're attempting to get there this year, there's usually a normalized spread over the 10-year Treasury. And, with the U.S. Treasury, the 10-year U.S. Treasury at kind of the 4% range today, on applying sort of the 150, 200 basis point spread on top of that rate, it implies that, mortgage rates should be kind of in the 6s, and we're pretty much there currently. And then if you kind of factor in, sort of taking the middle point, between the 3 to 7 cuts, that, and then with the 10-year, U.S. Treasury at 3%, we're looking at mortgage rates kind of in the 5s. So those levels are kind of what we're projecting, what we're expecting as our base case. Okay, this one is a little bit of a tough. This is kind of a tough one because things have not been feeling well. We all of us, we kind of just know something's not right, right? Like this whole past year, the investment sentiment is like really sour. Some deals have not been going well with, some of the other operators out there. So I kind of characterize this as a rolling recession, and it's kind of impacting various industries, more so than others, and kind of like a pruning, if you will, because at the macro level, the overall unemployment rate is still pretty low, kind of in the high 3s. So it's technically not a recession. It just doesn't feel very good. If you look at the stock market, and it's making new all-time highs, as we towards the end of 2023, the markets, starts to look out and discount, rate cuts. And, as we kind of transition from a quantitative tightening to a more quantitative easing environment, and the other thing is, the US government has been engaged in very steep deficit spending, and there's a couple of wars going on, and all of these things are very inflationary, so, and this is why, like, we're not really seeing true recessionary numbers, but it doesn't feel good, right? Something's off, right? Couple of points that I want to make here is that the lower middle class will be more severely impacted by the recent inflationary conditions because they don't own assets, right? You really have to be in assets in order to stay ahead of inflation or at least hedge against it. And that's our tenant base. This is we're in for workforce housing, and so this is something that we pay very close attention to. And so with that, we're not expecting any meaningful rent growth in 2024. And also in some markets, there's going to be new multifamily supply coming online. But luckily, since we're pretty focused in Tucson, we're not having to deal with that. A couple risk factors to consider. I mentioned in the previous slide that we don't expect to see a meaningful recession. Not that there is no probability that that's going to happen, but a couple of things that might cause a deeper recession would be, if all the rate cuts from last year, the aggressive rate cuts make their way through the economy, and then maybe we haven't fully felt haven't felt the full impact of the monetary tightening conditions from last year. So we're still waiting to see how that plays out. And also, another potential risk area is that, the Chinese economy being one of the largest in the world, they've been sputtering. They haven't really come back online, post COVID. They made a couple of attempts, and just recently, they started to engage in quantitative easing. They're lowering their interest rates and then probably getting ready to print, if not already. Um, Another area that is of major concern, and this is frankly, I'm a little bit surprised that this is not talked about more often on social media, which is BTFP, right? This is the Bank Term Funding Program that was instituted by the Fed in March of 2023. If you guys remember, several regional banks got into trouble, right? They let Silvergate, they let Signature, they let Silicon Valley Bank, go out of business, right? And even First Republic, which a lot of business owners bank at because they do a great job, they got taken over by Chase, right? And so what happened there was when interest rates rise so quickly, um, it causes the loans, the assets on the bank's balance sheet. They own primarily U.S. Treasuries and mortgage-backed securities, and interest rates and bond prices always move in opposite directions. So when the Fed raised interest rates so rapidly, so quickly, in such dramatic fashion, it caused a major haircut in the values of the bank's balance sheet to the tune of upwards of 25 to 35% haircut. And that ultimately meant that many regional banks, community banks became insolvent. In order to prevent a massive financial system meltdown, the Fed instituted the BTFP program, which basically allows the banks to borrow the face value of their assets from the Fed so that they wouldn't be insolvent. Well, that BTFP program is maturing on March 11th, 2024. So then that begs the question: will the Fed um, I should say, will the Fed extend this program? Because the banks are still in the same situation. Interest rates have not really started dropping meaningfully yet. So they're still in this predicament. So is the Fed going to extend this program, or are they going to allow the markets to throw an uproar, and uh, take a major for the markets to experience a major correction, um, or wait for a couple large banks to fail before the Fed will cut rates or uh, extend the BTFP program. So just a quick uh, a little bit more on the BTFP. This is a chart from the FDIC, and this is showing that in aggregate, the banks have they have a whole of $685 billion in the balance sheet. And so in order for this to be resolved, the Fed will either have to extend the BTFP program, or they would have to cut interest rates so that those values can come back. We expect both to happen, just don't know exactly when. So rates are likely to come down in 2024. The big question is how soon. And what happens is that as rates start to come down, all that money that had been invested in money market funds earning the 4.5%, 5% will start to look to go back into assets. And I think everybody knows that 2024 is an election year. And I can promise you there'll be plenty of drama, lots of fake news, lots of shenanigans. But the one thing that politicians love to do is to promise people a lot of things, right? Because that's how they win votes, right? Well, earlier I mentioned to you that we're already running a budget deficit, so any kind of new spending has to come from more money printing. More money printing, more quantitative easing, lots of cash, lots of money swishing around means that hard assets will go up in value or go up in price at least. And so we're basically expecting lower cap rates towards the back half of 2024. And finally, I want to conclude by saying that the market may have gotten ahead of itself. We were looking at all-time highs going into the end of the year as as Jerome Powell quote unquote pivoted. But what we do expect to see is it's going to take some time for the market to digest, as we transition from a quantitative tightening to a quantitative easing regime, and for us to see when the first cut actually happens. So the market's going to be a little choppy for the next several months, but ultimately, we will get into a quantitative easing environment and ultimately end the year with positive gains. So with that, let me turn this back over to Adam.
Great, thank you, Joe. So as you talked about, real estate being a hard asset, one of the things that we're going to address here is where's the best place to put your money and why. So multifamily, this year, as you know, last year, the stock market in 2023 had a really solid year. And you're already seeing a lot of the hedge fund managers out boasting about how great their performance were. Joe and myself actually spent many years on Wall Street. And while the market, the S&P was up 25%, a lot of hedge fund managers are boasting that they were up 27, 30%, slightly outperforming. One thing to keep in mind is stocks historically have the S&P has averaged about an 8 to 9% return. And what's great about multifamily is, our average annual returns are in the 20s that we target. But also multifamily, it's recession resistant. What are the things that people need when their times are tough? They always need food and shelter. And many times too, in the macro environment, when you see people not buying, rents actually increase because people are not buying, so they need to rent. And this slide here shows you how multifamily is done in tough times versus when people in tough times, there's a flight to safety, and there's no safer place than the bond market. And this here shows you how um, you know, real estate, specifically multifamily, is outperformed during the Great Recession, during the dot-com bubble. So now getting into the specific markets, one key thing I addressed early on was that we are focused and disciplined and only really focus on a handful of markets. Phoenix being one of them. And I'm not going to spend too much time. I'm going to focus more on Tucson since that's where our most recent deal is. But I moved to Greater Phoenix about 7 years ago, and the growth is noticeable. You don't even need to look at numbers like this. Just living here, you notice that how many people have been moving here in the last several years. Now, the rental market in Phoenix, after several years of sharp growth, 2023, there was a little bit of a contraction, but it's still pretty significant. And the next few years, we're expecting the tail end of 2024 for it to pick up for Phoenix, and then get back to that historical 3-ish% growth thereafter. And even with the rents coming in, the occupancy rate has hovered right around that 93, 94% range. This here is just to show you the historical occupancy rates. It's right, as I mentioned, that 93, 94% range. And here's the year-over-year rents that we've seen in Phoenix. That the middle line that represents zero. So above that line is growth. As I mentioned, 2023, we saw a slight pullback, but it's already picking up. And towards 2024, the tail end, and then thereafter, we're expecting to get back into that 3-4% growth range. And here's just one additional slide that shows you where rents are and we're expecting them to continue to grow. Both Phoenix and Tucson are very affordable cities. And this just reminds people that, Maricopa County, where Phoenix is located, it is one of the biggest counties, not just in a population, but actual size. And it's becoming much more diverse when it comes to jobs. There was once a time that when you're looking to invest in certain cities, you want to make sure there's economic and employment diversification. If one city is very heavily related on one segment, that segment has a down cycle, it can hurt the multifamily market. But as you can see, Phoenix and Tucson as well, we'll get to that slide in a little bit, are very diversified when it comes to the workforce. We're seeing a lot of growth in the tech space, financial services. There's also a very strong presence in aerospace and defense and healthcare. So now getting to Tucson, this is where our most recent deal, Spanish Trail, is. Tucson in 2023 was the second top inbound city where people are moving to domestically. Phoenix was actually fourth. So 2 of the top 5 cities are in Arizona. Now, what's interesting is, before this slide, I showed you that there was a bit of a pullback in rents in Phoenix after several years of growth. We did not see that. Tucson, the rents continued to uptick all through 2023. I expect that to accelerate going forward. And this, the previous chart where I showed you Phoenix, the middle line represented 0. The bottom line here represents 1%. So as you can see, in 2023 in Tucson, even as, it didn't show a sharper growth, but there was still growth. And we expect that growth to accelerate through 2024 and then sort of, get back that 3-4% range from 2025 going forward. And this here shows you the dollar value of rent where it is right now in Tucson. And, one thing that we also are very bullish about Tucson is it's a very affordable city, as is Phoenix. But here just shows you the rent. you can get a very nice apartment in Tucson as a blue collar worker for about $1,300. And as Joe mentioned before, one of the things about our apartments too is our apartments we purchase and acquire are much more focused on working class people. As you can see, Pima County, the last two lines of the slide shows you the white collar employment versus blue collar employment. So Pima County is much more of a blue collar town than Phoenix is. So now I want to get into to what to look out for when you're looking to make invest in a multifamily property. I'm sorry. Sorry, the slide kicked back. So these are some of the red flags that that you should be aware of when you are vetting an operator. As I mentioned before, vetting an operator is the most important thing you can possibly do when you invest in a multifamily syndicate. The first one to me that really is should be the first thing you ask somebody is how much does the operator have personally invested in the deal? If the number is 0 to a significantly lower number, that's a number that sounds low, it is a big warning flag. No operator is going to work as hard if they don't have their own money personally invested in the deal. Two other items too to be aware of is if the operator has been overly aggressive and chasing deals. One of my favorites, when I worked on Wall Street, one of the favorite books I read was called Beating the Street by legendary investor Peter Lynch. And one of the things he talks about in the book is it is imperative to have an investment strategy and never waver from it, even if times are good or bad. You have to have those parameters. And in the last several years, we saw in many cases people chase deals. They bid up for them. Oh, other people are bidding up. We must do the same. And got themselves in trouble. And also, too, is some people grew their teams a little too large. And in doing so, people often have to chase deals because they have to close deals to pay their team. So those are a couple of things related to keep an eye out for. The next one is debt service cover ratio. So what that is if you look at the deal's bottom line, the net operating income, you divide it by the debt service, the amount of debt they must pay on a monthly basis, or you can do it on a yearly basis as well. You want to make sure there's a good buffer in that number, because if there was something unforeseen to happen, you want to make sure that it is covered. And if it's not, gets to the next point of what will happen is you'll receive a capital call. If the debt is not being able to be paid for on a monthly basis, the operator goes back to his investors and says, hey, I need additional money. So you always want to check too with an operator, have they had capital calls in the past? And it's a binary question. Hopefully the answer is no. And if the answer is yes, they should have a very good explanation. If they dodge this question, it is a huge red flag. And getting that, I'll get to that in a little bit, but we at Break of Day Capital have never had a capital call. So why Break of Day Capital? I mentioned before you're investing with the operator first and their team first. So I addressed that, Gary's track record. But also too, it's very important to be in communication. Joe Feng and myself, we are the investor relations team, and we're always here to answer questions. We spend our entire day on the phone. And at the end of this, we're going to give you our email addresses and numbers so you can feel free to reach out to us anytime. But also with communication, it's very important too that they're very upfront. And with Break of Day Capital on a monthly basis, when you invest with us, you will receive a notification how the deal is going. If it's doing better than expected, you'll see. Well, you'll see the numbers either way, but there's also the explanation. If the property's out, we'll tell you this. Look at the numbers, and this is why. If it happens to be outperforming, we'll tell you that. We'll be upfront with that, and also tell you our solution of how we look to close the gap with our numbers. Under Break of Day Capital's umbrella, there's been over $24 million worth of distributions. And as I mentioned too, when you vet the operator, one of the key parameters that Gary's always stuck with when he looked at a deal, why he hasn't chased deals, and this is our first deal in 15 months, is he wants to be certain that he can increase the NOI by 40% within the first year. That's his parameter, and he never wavered for that. Never chased deals, never got overly aggressive. He stuck with that while a lot of people were chasing deals in the last few years. As I mentioned, we've never had a capital call. We're very disciplined and only focus on a few markets. We're mostly focused on Arizona right now, the Tucson specifically. And I already addressed that. We've only had one deal in the last 15 months. We have not chased deals. Spanish Trail was our first deal we closed. And we are targeting with the fund, we're targeting about three to five deals in 2024, probably towards the second half of the year. Now, here's just a slide of our investment classes. We offer 3 different classes. I'm not going to spend too much time going over this, but if you are looking to invest in us, Joe and I will gladly go over this in further detail. Now, the projected returns. With multifamily, the big number is what happens is when the property is divested. That's where you see the huge upside. And with Spanish Trail, we're targeting just over 2 times equity multiple within 3 to 5 years. So if you invest $100,000 with us in this model, we're expecting to give you back $200,000 within that 3 to 5 year window. So going back to that when I mentioned before that Gary has a real key investment parameter, being able to boost NOI 40%. Spanish Trail, which we just closed, one of the key items there, and this really just shows you how sharp of an eye Gary has, is when he was doing the due diligence on Spanish Trail, one item that really caught his attention was the water usage. Why was it so high? We owned 5 properties within a 3-mile radius. These numbers look way out of whack. What is going on here? So upon further review, doing the due diligence, visiting the property, he noticed immediately that the toilets, shower heads, and faucets were all very high usage. The toilets currently are using 3.5 gallons of water per flush. Well, we can get that down to 0.8. Shower heads currently use about 2.5 gallons per minute. We can get that down to 1.5 gallons by replacing them and adding aerators. And this is not a very difficult renovation to do. Some renovations take 6 months, years. This is going to be done immediately. We already have it scheduled, and this should be a 10-day-ish type renovation. And what value would that add to the property? $138,000 immediately to the bottom line, net operating income. And dividing the $138,000 by the standard Tucson cap rate of 5%, that boosts the value by $2.8 million, rounded up immediately to the property. So as I mentioned before, if you have any questions, this is our webpage, our QR code. Joseph and myself can be reached via email or telephone call. My email is adam@breakofdaycapital.com. Joseph's joseph@breakofdaycapital.com. And with that, we're going to open up to questions. If you have a question, what you can do is you can type it in that Q&A box on the screen.
Hey, Adam, I think you got a question in the chat.
Yes, I just see it. So what is the minimum investment? On the pitch deck, it read $100,000, but people can invest as low as $50,000 into our deals.
Adam, we have a question from Laura. Do you want to take that one or should I?
Oh, you can, Joe.
Okay, sure. Yeah. So the question is for everybody, it's how much does Gary have personally invested in Tucson? I don't know if he's comfortable comfortable with me sharing this, but I'm gonna do it anyway. I think he's got 90% of his net worth invested in all of the deals in break of day capital. So let's just say there's plenty of skin in the game. Of that, I think the vast majority is in Tucson because that is a market that we really love, and it's just not as picked over as Phoenix. So we continue to enjoy operating there.
I see another question. The question is, are you soliciting only for the fund, or is the deal level at Spanish Trail still available as well? Yes, Spanish Trail is still available to invest in.
Adam, did you see the question from Sherry? I'm in Eastern time. I tuned in at 7. Will in progress. The niche market for this year. Oh, um, Adam, I think you were saying that you had some data points on what were some of the top markets, and then I think you mentioned where Tucson and Phoenix were. I
Yes,
don't know if that answers our question, but
sure. Yeah, no, we're as I mentioned in this presentation, we're very bullish on Arizona, continue to be so. Tucson and Phoenix, when it came to the top inbound markets domestically, the cities that people were moving to, Tucson was second and Phoenix was fourth. Arizona is the only state that had two cities in the top 5 or even the top 10.
question from Ken. He's asking if he can use 401k funds to invest, and the answer is yes. We definitely take IRA money for either the fund or you can go into Spanish Trail directly as well.
Mhm. Joe, you see,
Um,
next question. Um, any properties currently being looked at, consider currently for the fund, or is completely up in the air?
um, so we allow our investors to choose between investing directly in Spanish Trail, or they can be invested in our multifamily impact fund. So with Spanish Trail, you are only exposed to that one asset, and so all of uh, the economics of Spanish Trail will be you have direct exposure to that. With the fund, um, you will have exposure to Spanish Trail and whatever we buy over the next 6 to 9 months, or whenever the fund is a close-ended fund. So at some point we will close it. I believe it's around summer of 2024. It's either the earlier 1 year anniversary, or we get to our targeted um, 3 to 5 properties. Having said that, though, while it is a blind pool fund, we have a very tight buy box. So we only focus on Class B and C, workforce housing, 100 plus units, uh, 1980s build or newer, and some of the things that Adam mentioned earlier. There's got to be enough meat on the bone, right? One of the metrics was that we have to be able to generate a 40% increase in NOI in year 1. So those are just some of the criteria that we have with the mandate.
In one piece too, Joe, I don't think I addressed it when we talked about his investment parameters being a 90% increase. Gary's accomplished that in 9 straight deals too.
It looks like so Sherry had a follow-up question. I think she's asking about the type of property. So if I understood you correctly, Sherry, I would say this. Um, the reason why we like workforce housing, multifamily residential, Class B and C space is because not only is it a great inflation hedge, but it is also recession resistant. What Adam mentioned earlier, people do need a roof over their heads. They don't necessarily need to work in an office, but they still need to work, or I should say, they still need to have a roof over their head. They may not need to live in a class A luxury property, but this is definitely something that most people can afford. And so this is why we purposely picked this middle space value add. We're fixing up outdated properties. We're generating value for investors by buying older properties and fixing them. Want to try that one, Adam from
Yeah,
Scott?
sure. So the next question is, I am curious what impact the lack of a border control is having on the Tucson market. I've not visited in quite a bit, but I'm generally curious if this is a positive or negative for the rental market generally. Um, yes. So the last time, I was, living in Arizona, border state, we hear a lot about it. But I have to say, living in Greater Phoenix, and somebody goes to Tucson quite frequently, I haven't noticed it having much of an effect on there. You don't see just a swarm of immigrants there, but at all. I've not noticed that. Uh, is it positive or negative for the rental market generally? Um, that's very debatable. I don't think these people in general don't have money necessarily to rent, and if so, they're probably going to be using Section 8 housing. So that hasn't. I wouldn't say it's. I would say it's indifferent would be the word to me. I wouldn't say it's positive or negative right now to either our property or just the Tucson market as a whole.
Yeah, this is a very interesting question. I definitely do not think of it. It's not an issue. But to Adam's point, I don't know if it's incrementally, positive, but I definitely don't think it's negative.
Mhm.
I mean, well, here, I'll throw a funny one in there. I know that the Border Patrol is one of the top employers in Tucson. So I don't see any more questions in the chat. Oh, actually, wait, hold on. We got a couple of boxes going on here.
Yes. So
Uh,
here's yeah.
yeah, actually, there's quite a few in here. Well, uh,
So
Laura is asking about tax advantages for this year in Spanish Trail. Do you want to take that one?
other tax advantage for Spanish Trail, yes. For 2024, the bonus appreciation in the tax law is 60%. And we estimate that for Spanish Trail, the once we got the engineering report in, that the bonus appreciation is going to be plus or minus 70%. So you will be able to get to, if you have passive income gains, you need to offset. That is a figure. The full 60% you're allowed to for 2024 you will occupy that entire amount, and the remaining part of the bonus appreciation you carry over to the next year.
Yeah. Uh, Next question. I'll take this one. Is there an
Sure.
equity
Yeah.
multiple
Mhm.
or target IRR for the fund? Yes. So the equity multiple is in excess of 2x over a 3 to 5 year hold. And the targeted IRR, it's kind of the more standard-ish, 15 to 18% IRR. But our internal goal is always going to be higher than that.
Joe, why don't you take the next one revolving
Yeah,
the taxes? Yes.
I can. So this is a really good question from Maylee. She says, if I invest with my Roth IRA money, do I have to pay federal state taxes on the gains? So this is a really good question because there's a nuanced point in where when you invest with IRA money into an investment that uses leverage, which clearly we do, right? We have senior debt on a syndication. And so you would trigger something called UDFI. It's a type of unrelated business taxable income. So really the way to get around it is to invest with a solo 401k money. Um, the UDFI is exempt if you were investing with solo 401k money. And then definitely consult with your tax advisor on an IRA specialist. But let me just say in general, uh, depending on how much you invest with a Roth IRA, the taxable um, gains for the leverage portion of the investment may be insignificant. Okay, so there's a schedule that one would have to follow. So generally speaking, if you're investing $50,000 to $100,000, the taxable gain on the leverage portion of the investment is negligible. But again, check with an IRA specialist. They can actually do the calculation for you. Okay. Anything else, Adam? Those are some good questions.
Excellent questions. I don't see any ones coming in. Here's one.
Oh, okay. So yeah. So UDFI, I believe it stands for, and don't quote me on this. I have too many things to remember. I think it stands for unrelated debt financing income. Okay. And so what it is uh I didn't want to get too deep into this. Basically the IRA, the IRS does not want you to be at an advantage versus somebody who is not using our money in an investment, and therefore they want to tax you on something. Um, they want to make sure that they want to try to make the playing field fair by taxing you on the leverage portion of your investment. That's I don't know how else to explain that. Again, an IRA specialist would give you a better explanation. But it's a type of UBTI that is that incurs on an investment that uses leverage, and the only way to get around it, is to use solo 401k money. And mainly, if you want, go ahead and schedule a call with Adam or myself, and we can get into the very technical, end of that. But we probably shouldn't comment more than that. I mean, you really should talk to an IRA specialist. It's getting into the weeds. But good questions.
Excellent questions.
Yeah, maybe mainly if you want to just send Adam an email, and then we could put you in touch with one of our preferred vendors. So yeah. Yeah. Okay. So what Gregory says, look up UBIT. Yep, that's right.
Mhm.
That's the tax, right? But passive income gains are depreciate in the Roth. Depreciable in the Roth. Yeah, I do agree with that. So uh the depreciation that is incurred as a result of investing in one of our deals can be used to offset UB UBIT or UBTI, or in this instances, UDFI. They're all UDFI is a type of UBIT,
Mhm.
but that is correct.
Two questions just came in. The first one, are the new deals in the pipeline to fill out the fund? From Scott. So Scott, we don't have any. Spanish Trail's a deal we just closed on, and we're still accepting investors' money on that one. But currently, we don't have any specific properties right now that we're looking to acquire. As I mentioned, Gary's very disciplined, has his investment parameters, and if a deal presents itself that looks very attractive, and as I mentioned, be able to boost the NOI, at 40% within the first year, certainly would submit an offer on it. But currently, there's no specific deal that we have that we're in the process of acquiring currently.
and we may never get anything, within the allotted time of the fund, right? I mean, if we can't get the deals at the prices that we want, we walk away like we always do. So there's no assurance that we'll even do another deal. Um, Let me answer Laura's question. Yeah, so we still have a little bit of room left in Spanish Trail. We've been we've engaged a few different groups indicating anywhere from 300 to 500,000 in interest. And yesterday somebody just committed for 1.5 million. So we have just a little bit of room left. So if you're interested, definitely let's have a conversation or let us know as soon as possible.
Okay.
You want to try to take Scott's question or should I?
Yes. So Scott is asking a question. He says, looking to put cash to work. So I'm concerned about cash not being deployed. However, I totally agree on the discipline and deals. Well, Scott, as he was just as Joseph was just answering a question previously, we currently have a deal, as I said, Spanish Trail, the one that the one that I specifically talked about in the presentation, where you're going to see a huge boost to the NOI by the water usage. We're also rents are well below market. So if you are looking immediately to invest, Spanish Trail, as I mentioned, there's still openings there to invest where your money will be immediately deployed. So I'm going to go back to it looks like there's
Oh, Adam, maybe drop Mei Lee your contact info. Um, if you want to just type it in the chat box, and I guess everybody could see it, or we could, or maybe just if you want to just sound it out, because we could set her up with the guys that directed Ira to learn more about Oh, okay. Oh, she doesn't know. Okay.
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 Yeah, as we mentioned earlier in the call, Joseph, myself, where we speak to investors all throughout every day throughout the day, even sometimes on weekends. So please, anything that was not answered or not addressed, email us, call us. My number is in the bottom of every email. If you want it, it's 602-529-2056. And as Joseph's and my emails are very easy to remember. It's adam@breakofdaycapital.com or joseph@breakofdaycapital.com. So if anything was not addressed, or if after this call something comes up that you're want to know more about, reach out to us. We'll gladly speak to you and answer any questions you have.
Adam, if I may just introduce myself to Mei Lee.
Yes.
So Adam and I have very similar backgrounds. As mentioned, I spent over a decade in the asset management business, worked at a hedge fund in New York City, and then for a large global fund manager in Los Angeles. For over 20 years, my wife and I have owned and operated real estate, specifically small multifamily in Southern California, where we became tired landlords and beaten up landlords. And so over the last 7 years, my wife and I have invested in close to 60 syndications, and seven of those are with Break of Day Capital. I've known Gary personally for close to 7 years now, and I've invested very successfully with him. Two of their deals we exited at a 2x multiple, and then another one with a 3x multiple. So obviously, I really enjoy the way that Gary does things. You know, he's a strong operator, great communication skills, and not only quality but consistency of communication. I really loved his style, and so I decided to join the team a year ago.
Any further questions?
And you're more than welcome, Maylee. And then, if there's anything Adam and I can do for you, I have a huge passion for investments, and I just love helping people construct their portfolios. So, whatever we can do to help, just please do not hesitate.
Mhm.
Yeah, Adam, I don't see anything else. Just I guess whenever you're
Yeah, I guess thank everybody for attending our 2024 Outlook call. This call, has been recorded and there will be available to review. And once again, Joseph and I thank you. And any questions or anything arises, reach out to us and we'll get back to you immediately and we can discuss this further.
Thank you guys. Appreciate your time.
Thank you, everyone.